Welcome to the Asset Coach and Tax Strategist YouTube channel. If you're a subscriber, thanks so much for subscribing. If you're a first-time viewer, thank you for spending your time here with us. If you like our content, please give us a thumbs up. For you new folks, Asset Coach Tax Strategist YouTube channel is based on the book Economic Termites. This is a book that I wrote a few years ago talking about taxes, inflation, time, laws, and regulations. Also, I wrote a second book called Farming Assets. Those two books is really what this whole channel is about, addressing those situations and how they affect you and I in our ability to grow our wealth. So as an asset coach and tax strategist, my name is Robert Wolf. I am the CEO and founder of Terra Firma Business and Financial Consultants and its affiliates. We have a bunch of companies that we've built out this ecosystem surrounding the basis of what we talk about on this YouTube channel. So if you're not a subscriber, hit that subscribe button. We drop episodes every Thursday. Again, if you are, thanks so much. And let's get into this next episode. So today's episode is really focused on what I get back from a lot of, so Terra Firma, we work with a lot of physicians and business owners. And a lot of times when we're communicating strategies and recommendations and all this fun stuff, we always get people that are, right, they're doing their research and they're coming back with all these questions and blah, blah, blah. How do you do this? How do you do that? All that fun stuff. And I want to kind of take a step back, because I think it's very important. In my book, Economic Termites, one of the things I talk about is taxes, as taxes is one of the major termites. Inflation, time, laws, and regulations are politicians. Our politicians kind of the queen termite, right? But one of the main things is taxes. And everybody wants to reduce their tax liability. Everybody feels it's unconstitutional. Everybody, right? Blah, 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 blah. Whether it is or it isn't, it's here. Right? To what extent today versus tomorrow or yesterday? It's here, right? So here's kind of where I would like to share some of my opinion and my thought process. I think a lot of people look at the IRS tax code. First of all, it's a legal system, right? First and foremost, it's a legal system. And not only is it a legal system because our politicians create laws, they give it to the Treasury Department. The IRS has to determine how the tax codes link to those particular laws based on what that law has indicated. Same thing within investing. Investing's a legal system, right? And that's governed and watched over by the Securities Exchange Commission. So in these legal systems, you have assets, and the IRS taxes assets. So here's kind of where we want to look at this is that when we look at taxes, they really are a symptom. So what's that mean? They're a symptom of what? Well, of assets, of income. So for example, if you're a W-2 employee, you are the asset. You are the asset and you're creating income. Your time, your expertise gets that income that is being taxed at that type, you being a W-2 asset. Okay. If I'm a business owner, I could be the asset, but the business also could be the asset. If I'm taking a W-2 out of my business, then I'm not only just the owner, but I'm also an asset to the IRS from a W-2 perspective. If my business generates profit, that flows down to me. If it's a pass-through entity, I pay taxes on it. That's the symptom, right? So what do we need to do in order to reduce our tax liability? We need to go to the root cause. We need to look at assets and understand how our assets are structured, how they're organized. But this goes back to the legal part of things. So the IRS tax code's written for business owners. Plain and simple, it's written for business owners. It's written for those who have something to save something. If I'm making 60 grand a year as a W-2 employee, nothing wrong with that. I have been there. I don't have a lot to save on taxes. I'm a W-2 employee making 60 grand a year. Doesn't make me a bad person. Doesn't mean the IRS doesn't like me. It's just where I'm at in my situation. But if I'm making $600,000 as a business owner or as a real estate professional, then the IRS tax code has different benefits for me. And I can reduce my tax liability to where my taxable income is lower due to these types of assets and these types of structures. So the tax code's written for business owners, and the more you have, the more tax code you have access to. It's no different than if I have a lot of money, I can invest money in different areas and different investments and diversify. Versus if I don't have a lot, I really can't, right? So it doesn't mean that the system is rigged. It just means that the more you end up having, the system is there for you, and the more it gives you. Why? Because the wealthy invest in the system. The IRS invests in business owners by giving them more cash flow so they can take more cash flow, put it into their business, grow their business, having to hire more employees. That's the tax revenue the government's looking for. Why am I bringing all this up? Because so many times when we're looking at strategies, when we're looking at business strategies, and when you're looking at business strategy, you're using legal entities, LLC, partnership, S Corp, C Corp, trusts. You're using these various entities and how the legal system structures these to separate liability. And then as a byproduct, you get a tax benefit for it, or it's linked to the tax code, and you got to prove what you're doing. Now, here's the interesting thing. The IRS doesn't require you to make profit. They do say you need to be in business to try to make money. You need to be legitimate. Okay, so that's an interesting aspect, but every business has a different structure. Am I manufacturing? Am I a financial advisor? Am I a hospital system? What kind of business am I? And what part of the legal system and tax code do I get to qualify for? It's totally different. The IRS doesn't micromanage that, though we feel like they do. We feel like the IRS is, you can't do this, you can't. No, they're not saying that. Your CPA is saying that. Why? Because they're looking at the tax code from an accountant perspective, 2D. The IRS is a 3D system, and in sometimes it's 4D. It sees into the future. Okay? But most CPAs, most of the time when you're going and doing research, you're getting answers to your question. Those are 2D. That's not how the tax code's written. The tax code is an evolution of you and what you're trying to accomplish. And it's not in a finite time period. It's in an infinite time period based on what you're trying to do. Decisions you make. Right? And so we don't see that. And so as a business strategist, when you think about the wealthy, how many times do they, like Amazon, for example, when they became a public company, they still showed a loss on their financials every year for like 19 years or so. Why? Because they kept taking all their profit, putting it back into the business. The tax code was giving them a bunch of benefits from that, and they showed a paper loss. Did anyone go to jail? Did all of a sudden people stop investing in Amazon? No. What happened to Amazon? They just kept growing. The IRS invested in that business partnership, and Amazon continued to utilize the business partnership of the IRS, and they continued to increase. Same thing with Warren Buffett. He owns insurance companies. He uses the structure of insurance companies and insurance float to create income, to use that to invest in other assets. But he also has a huge stock portfolio. Berkshire Hathaway has a huge stock portfolio. Does he pay capital gains tax on his Schedule D for his stock portfolio in Berkshire Hathaway? No. His stock portfolio is revenue to Berkshire Hathaway. Why aren't we doing the same thing? The dude's been doing this for like 5 decades, 6 decades. He's proven the pathway, but we don't do this. We just follow what our financial advisor tells us to do. This is what I mean by strategizing. The tax code is not a 2D event. It's not a 2D system. It's a 3 and sometimes 4D system. So understanding that when you're going to go research, and you're like, wow, Bob, the IRS tax code says if I invest in real estate, then I'm not going to be a real estate professional. How do you know? You just bought one property. How does the IRS know? Nobody knows. You just started. You realize that IRS tax code allows you to file amendments for the last 3 years, meaning tax returns that you have already filed to them. There's already been calculations. You've already paid taxes. You've already gotten refunds, whatever it is. The IRS allows you to refile those over the last 3 years as amendments if you find certain things. One of the big things are like tax credits. Do you also realize no different than as an individual taxpayer, when you sell assets, real estate or stocks, bonds, mutual funds or whatever, and for a loss on your Schedule D, you get to carry forward that loss, but they cap it at $3,000 a year. Do you realize that same activity in a business doesn't cap at 3,000? It doesn't even cap at your cost basis. And you can carry forward those same losses on your business just like you can personally. But the dollars are significantly larger. Why do they do that? Because they're a good partner. They realize, man, that sucks. You took a loss. That must have hurt. Or, wow, that was very smart. That was very strategic. Because now you can take that loss, create this reservoir of a loss to offset future gains, which is still a valuable tool, still a valuable strategy. So I'm going through this process because I need you to understand that the IRS tax code is an evolution of you, decisions you make. You have this runway to prove what you're trying to do as you're evolving in this business. So yes, you can be a W-2 employee. You can create a business, a side hustle is what people say, or it's not a side hustle, it's a very strategic structure because you have a plan to help build a business while you're still W-2. Absolutely, you're still working it, but there's nothing saying that you can't. What's a full-time employee? 500 hours a year. 500 hours a year or more is what active income is considered in the IRS tax code. So if you're working 40 hours a week, 50 weeks, so 40 hours times 50 weeks, because we'll just say you get 2 weeks off as an employee, that's 2,000 hours. What are you doing with the other 1,500 hours if all you have to do is qualify to be active income 500 hours a year or more? Do you still have time to have another full-time business that takes your full-time hours? Yeah. Okay, what's 24 hours times 7? That's 168 hours a week you and I have. So if you're only working 40 hours a week, that means you have 128 hours left. Let's say you sleep 8 hours a night. We're going to subtract that 40 hours. Plus another 16, sorry. That's still 72 hours. You still have 72 hours in the week. Could you have a side hustle? Or could you have a business that you're trying to grow? Absolutely. And here's what's awesome about that whole material participation rule and guideline. There's 7 tests, not one. If the IRS was so big, bad, mean, you're after the little guy, why would they have 7 tests to qualify material participant? That really sounds like your business partner's trying to do everything it can to give you the opportunity to prove that you can materially participate active income in something. 7 tests. So at the end of the day, and can you qualify for that right now? No, because some of those tests are over a period of time. 2 of the last 3 years, 3 of the last 5 years. So does that mean, oh, I made a decision today. Oh man, I can't take this deduction. No, It's an evolution. Business is an evolution. It evolves based on decisions that you make. That's why one of the things that they ask business owners to do is document or prove your participation. But the IRS doesn't tell you how to do it. They say you get to choose. Whether it's tracking your time, whether it's financials, whether however you choose to do it. So like what we do for our clients, our members, we actually record all of our sessions. We create meeting notes every session we have. That's the documentation of the activity. When we create videos for our members, we know they watch these videos. That is time invested in their business. Can't that be part of this process? Yes. Yes, it can. So this evolution of 2D, Bob, well, I Googled it or I chat GP'd it and looks like, yeah, I don't think I can do, I don't know how you guys are doing this. Well, because we're not looking at a 2D black and white piece of paper and answer. We're looking at a 3D. We're looking at the holistic aspect. The IRS, as your business partner, is looking at you holistically. They're anticipating you setting up a business that you're actually going to do this. Why in the world would you file with the Secretary of State with your for a business and get an EIN number, your SS4 from the federal government? Why would you do bookkeeping and submit a tax return if you don't have the goal to try to make money? Why wouldn't you? Why would you go through all that? Now, starting a business, yeah, there's no guarantee to profit. And when you just get started, when's the right day to start a business? Today? There is no special day. There is no start your business day holiday. Right? It's the day you decide, hey, let's actually start this as a business. Let's structurally organize this like legitimate. Let's no longer do this as a hobby. Let's do this as a real business. The best day to do that is today. And you get 365 days to make that decision in that year to still be a taxable year, to file whatever you did. So yes, you can set up a business in 1231, end up filing a tax return because you did have a business that year. And yeah, your cost of setting that business up can be on the tax return as a deduction. And you may not have made any money because you just set up your business. So you can write that loss off by filing a tax return, having a loss that funnels to your Schedule E page 2, preferably. Done. Now the next year, we got to really try to make some money. We really got to figure out what are we going to do? Well, what's your business? What kind of business is it? Is it an auto body shop? Is it a nail salon? Is it a babysitting, dog grooming? Is it a management company? What is it? That's what you got to determine when you file with the Secretary of State and your operating agreement or your incorporate articles of incorporation. You're saying, here's what we're going to do. And then you try to do it. You realize Berkshire Hathaway was a mercantile? When Warren Buffett bought it, they're a mercantile business. Do you think they're doing that today? He realized, shoot, I've got a history with Berkshire Hathaway. It's been around for a period of time. I can go start a brand new business, but I might as well use the only asset this Berkshire Hathaway business has. And the only asset it has is its time in business. And I can sell off some of these assets that I have right now. I can take a loss, but then I can restructure and refile what this business is going to do. Happens all the time. Happens all the time. What makes you think you and I can't do that? It's because you don't know. You don't know. You're just doing your research and you're getting your 2D answer. And you're falling farther and farther behind because your CPA is giving you 2D answers. You're coming up with ideas and you're sending it to your CPA and they're like, no, you can't do that. Well, why can't I? No, the tax code says you can't. Bull, because people are doing it. So how can I do it? That's the thing. That is the thing. There is not a no answer. There is not the way you're trying to, but here's how you can. That's 3D. 2D is no, can't do it. Sorry. Sorry. We're not Hunger Games. You're not getting to age 18, or you're not all of a sudden graduating and then the world says you're this. And then you're that forever. No, that's not how it works. Nor does the tax code work that way. Nor does business work that way. But it's not easy, or everyone would do it. It's hard. It's hard understanding and working with your business partner, the IRS, of trying to figure out how to make money in business, how to survive and how to thrive. It's hard. Zigging and zagging, there's a cost to all of that. And then you have competition that you're trying to compete with, and that creates cost. And then there's the emotional fear and anxiety and man, if it was easy, everyone would do it. What's easy? Going to get a W-2 job. And it's costly. So you're going to pay your ordinary income taxes on your W-2 job because it's easy. Or you can do that and set up a business and try to start running a business and receive benefits from that, not a hobby. And in fact, when you do that, the IRS is so good in this relationship, they give you the ability to actually not work 500 hours to prove. They give you the opportunity to work 100 hours a year and not have any other taxpayer in your business. So you can create your quote unquote side hustle and work 100 hours. This is that whole short-term rental Airbnb strategy that everybody's trying to promote. Be wary. Be wary. You're pushing and walking the fine line of real estate professional. You realize that to material participate as active income in any other type of situations, 500 hours, because so many people try to take advantage of the IRS business relationship, your partner, they changed real estate material participation to 750 hours. And you have to be a real estate professional, and they have certain guidelines and rules. Why? Because you or people around us were taking advantage of the business partner. They're like, whoa, whoa, whoa. Don't you think the IRS knows about this short-term rental strategy? And guess what? The moment you hire a manager, the moment you start hiring people to clean the property, the moment you start buying more and more properties outside of your area, the IRS got you now. Because you're trying to take advantage of your business partner with this short-term rule, right? And you hired people to do all the things that you should be doing. That sucks. Because now you have all this real estate. You're not a short-term rental. You're not meeting the 100 hours. Now you're not meeting real estate professional guidelines. Now you're what? Not getting all those tax benefits. But so-and-so said... Well, yeah, because you were blinded by this big idea of taking advantage of the IRS. No, 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 no. No. But you realize you set up your own LLC and you tried to go through this process of trying to build a business, and you have different assets and you have different focuses, and you start generating revenue from different areas. That LLC actually is a business. And you could actually qualify for that 100-hour rule because you're actually trying to make money and you're trying to run a business. You realize you can do that? That's what the IRS was saying, is that, look, hey, I get you're a W-2 employee. your business partner, I'm going to give you an opportunity to try to be a business owner and try to access the tax code the way I've written it for you. And I'm just going to throw you a bone. Here's how we do it. Go for it. Let's see what you're able to do. And it's not going to be easy. So I'm going to lower the hour requirement to try to get you up and running. But that's not how everybody looks at it. But that's the 3D of the IRS tax code. But when you don't understand that language, when you don't understand the dialect of the IRS, you're going to always see it in 2D. Thanks for joining us. Make it a great day.